Most investors look at this chart and see a crime scene. They see a broken growth stock that has been absolutely decimated, crashing 80% from its 2021 highs of $310 all the way down to the mid-50s. The narrative on Wall Street is brutal. They say it's a fintech dinosaur. They say Apple Pay ate its lunch. They say it's a value trap destined to go to zero. But when I look at PayPal in early 2026, I don't see a broken business. I see a massive disconnect between price and reality. While the stock price was collapsing, the underlying machine was quietly doing the one thing that actually matters: printing money. In the last 12 months alone, this so-called dead company generated approximately $6.2 billion in free cash flow. Think about that. The stock is priced for bankruptcy, yet the business is more profitable today than it was at the peak of the bubble. So we have to ask the uncomfortable question: is this the ultimate value trap that will grind sideways forever? Or is this the easiest double in the S&P 500 hiding in plain sight? Today, we aren't guessing. We're running the numbers. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. Before we get to the valuation, we have to understand why the market hates this stock. It wasn't just the 2022 tech crash, it was a structural disease called margin erosion. For years, PayPal was feeding investors empty calories. Here is what I mean. Their headline revenue growth looked great, but it was coming from their unbranded processing arm, Braintree. This is the unsexy back-end tech that powers giants like Uber and Airbnb. Now, Braintree drives massive volume, but it is a commodity. It has razor-thin profit margins. Meanwhile, the classic PayPal button, which has huge margins, was slowing down. So while revenue went up, the actual profit per transaction went down. The market realized the growth was fake, and they punished the stock for it. Enter the turnaround. In late 2024 and throughout 2025, CEO Alex Chriss completely flipped the strategy. He stopped chasing growth at all costs and introduced a new North Star metric: transaction margin dollar growth. He basically told Wall Street, "I don't care if we lose volume as long as we keep the profitable volume." And here is the smoking gun that suggests it's working. As of the Q3 2025 earnings report, transaction margin dollars, gross profit, grew by roughly 7%. This is the most important number on the slide. It means the bleeding has stopped. The core business is finally growing its profit pool again, proving that the turnaround isn't just a slide deck promise, it's actually showing up in the bank. All right, let's put PayPal through the first pillar of our verification test: revenue quality. Normally, for a tech company to command a premium growth multiple in the market, we demand a compound annual growth rate, or CAGR, of at least 10%. We want to see double digits. So how does PayPal stack up for the full year 2025? If you look at the data, they are on track to deliver roughly $33 billion in total revenue. That represents a year-over-year growth rate of about 6 to 7%. I'm going to be blunt. If you are looking for the next NVIDIA or a hyper-growth rocket ship, PayPal fails this test. It looks even uglier if you stare at the active accounts number. That figure has essentially plateaued at around 438 million. They aren't adding 15 million new users a quarter like they did during the pandemic. In fact, looking at the chart, that number has barely budged for a year. But, and this is a massive but, you have to distinguish between quantity and quality. Under the previous management, PayPal was obsessed with vanity metrics. They were literally paying people $5 just to open an account. Those users would grab the cash, leave, and never transact again. They were empty calories. The new management stopped that game. They are intentionally letting those low-quality ghost accounts churn off the platform. So, while the headline user count looks stagnant, the users that remain are actually transacting more. The verdict for Pillar 1? It is a fail on speed. This is no longer a hyper-growth disruptor. It has graduated into a mature GDP-plus compounder. It grows with the economy, not significantly faster than it. Now we get to the most important part of this entire analysis. We call this the truth metric. You can fake earnings per share with accounting tricks. You can massage revenue with acquisitions, but you cannot fake free cash flow. It is the cold, hard cash that ends up in the bank account at the end of the year. So, let's look at the reality of PayPal's cash register. The data. Over the last 12 months, PayPal generated approximately $6.2 billion in free cash flow. Now, compare that to the price tag. With a market cap hovering around $58 billion, the math is simple but staggering. $6.2 billion divided by $58 billion equals a free cash flow yield of roughly 10.7%. Let me put that into context. The average company in the S&P 500 gives you a yield of about 3% or 4%. PayPal is giving you nearly 11%. This is elite territory. This is what you typically see in deep-value energy companies or tobacco stocks, not in a global fintech platform with 400 million users. Capital allocation. The cannibal effect. So, what are they doing with all this cash? They are eating themselves. In the last 12 months, management took over $5 billion of that cash and used it to buy back their own stock. They reduced the total share count by roughly 6%. Here is why that matters to you. Even if PayPal's business doesn't grow at all next year, your ownership stake in the company increases by 6% just because they are retiring the shares. The verdict for Pillar 2? This is a massive pass. This cash flow is your safety net. It is the floor that stops the stock from going to zero. Pillar 3 is the one that separates the compounders from the capital destroyers. Return on invested capital, or ROIC. This metric answers a simple question. For every dollar investors put into the machine, how much profit does it spit out? We generally want to see a number consistently above 15%. Anything less, and the company is arguably destroying value just by existing. The data. As of our latest 2026 check, PayPal's ROIC sits at approximately 17.5%. Now, I want to be fair here. If you compare this to Visa or MasterCard, which often have ROICs of 30% or 50%, PayPal looks merely good, not God tier. But if you compare it to the average company in the S&P 500 or a standard bank which might struggle to hit 10%, PayPal is still a highly efficient machine. The verdict for Pillar 3. This is a pass. The key takeaway is that PayPal is an asset-light business. They don't need to build factories. They don't need to buy airplanes or drill for oil. They write code, and that code collects fees. Even with the intense competition from Apple Pay, this 17.5% figure proves that the core economic engine is still intact. They don't need heavy capital expenditure to grow, which leaves more cash for those buybacks we just talked about. If you are bearish on PayPal, your argument is usually two words: Apple Pay. And you aren't wrong. Apple has effectively won the in-store war with the iPhone. But PayPal isn't trying to beat Apple at the grocery store. They are trying to win the battle for the guest checkout online. And that is where Fastlane comes in. This is the most critical product launch of the Alex Chris era. Here is why it matters. The problem: when you buy something on a random Shopify store or a new clothing brand, you hate creating an account. You just want to check out as a guest. Standard guest checkout is a disaster. It's slow, you have to type in your address manually, and conversion rates are terrible, usually under 45%. The Fastlane solution? Fastlane allows PayPal to recognize you by your email and unmask your saved shipping info without you needing to remember a password. The metrics? 2025 data. According to the latest data, shoppers with fast lane profiles are converting at roughly 80%. Think about that. The industry average is 40 to 50%. PayPal is nearly doubling the conversion rate for merchants. They are also clocking in speeds 35% faster than manual entry. The takeaway? This is the new moat. By unbundling the identity from the button, PayPal is capturing the users who explicitly don't want to log in. They aren't just fighting Apple Pay. They are becoming the default utility for the entire open web. So let's put it all together. What is this company actually worth? I've built a discounted cash flow model using the latest 2026 data. But here is the key. I did not build a bull case. I built a cynical case. The inputs. Growth. I am assuming PayPal grows at just 4% for the next 5 years. That is barely keeping up with inflation. I am assuming they gain 0 market share. The discount rate, I used 10%, which is a standard hurdle rate. The terminal growth, I capped it at 3%. The result? Even with these incredibly pessimistic assumptions, the model spits out a fair value of roughly $95 per share. Now look at the stock price today. It is trading in the mid-$50. That implies a margin of safety of nearly 40%. The multiples check. If you don't like DCFs, look at the multiples. Right now, you are paying roughly 11 times forward earnings for PayPal. The S&P 500 average is trading at 20x. Visa and MasterCard trade at 25x. The verdict? The market is pricing PayPal as if it is a dying newspaper company. But the math says it is a cash-rich compounder trading at half its intrinsic value. You are buying $1 for 50 cents. Let's bring it home with the final scorecard. 1. Revenue growth. Warning. Mediocre. At 6 to 7%, this is a warning sign. Do not buy the stock if you are looking for hypergrowth. Cash flow. Elite. With a yield over 10%, this is one of the cheapest cash flow assets in the entire market. ROIC. Strong. At 17%, the efficiency engine is still running hot. Valuation. Deep value. At 11x earnings, the downside risk feels significantly capped. My final verdict? At $55 to $60, PayPal is a strong buy for patient value investors. You are effectively getting a 6% annual dividend via buybacks, plus a free option on the fast lane turnaround. I have uploaded the Excel DCF model I used in this video, so you can plug in your own numbers. Click the link in the description to download it, and make sure to subscribe for my next diary. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.